Joining us now is Jens Nordvig, founder and CEO of Exante Data. Jens, let's start here. President Lagarde, Chairman Powell, Governor Bailey. What's your number one question going into that a little bit later this morning?
I would say, what matters more, growth or inflation, right? We're in a totally different cycle than we've seen for the last 40 years, right? That even if we have recession fears, the central banks are in a very, very tricky spot, right? Because inflation is way above target and they can't really focus on growth as much as they've done in the past. And I think if you look at what's going on in the market, right, we've clearly had the recession focus over the last couple of weeks, right? And nevertheless, bond yields are close to the highs, right? It used to be the case, the lesson for the last 40 years was as soon as there was any weakening in growth, you just had to close your eyes and buy bonds. And this cycle is totally different, right? Because it is an inflation cycle as opposed to just a growth cycle.
I look, Jens, at the path of inflation, and this would be my question today to these bankers, and it's a really esteemed panel to say the least, folks really pay attention to that. Jens, to me, inflation is bipart in that there's an easy path down, core comes down, and then it gets way, way more difficult. Where do you perceive the level of inflation where it really becomes heavy lifting for these central bankers?
Yes, I think we probably have a period where goods prices and commodity prices are going to come down over the next year. And that really has not much to do with central bank policy, right? And then the question is, if the wages and the services prices stay elevated so that a drop in those other prices don't really get the overall inflation numbers down that much, then the central banks are going to do the heavy lifting and really get tight. Don't forget, we're talking about the Fed having overdone it. How many months have they actually been hiking? A couple of months. We're a couple of months in here, right? And that's the discussion already, right? So the real tricky bit will be if they have to go to 3 and then considering going to 5. Well, that's when then the pain on the economy will be severe, right? Right now, we're really discussing about getting to neutral-ish, a little bit above, but not really tight. It's not a Volcker cycle yet, right? But that will come into play if the wages keep going, if the services prices keep going, even beyond the point where this supply issues has been fixed.
Yeah, just real quickly here, to your point, Loretta Mester this morning in Sintra said the Fed is just at the beginning of raising rates and sees rates going to 3.5% by the end of this year and a little above 4% next year. Has the market adequately priced that in?
No. So we at the moment, especially last week, we got to an extreme point where the market was actually pricing significant cuts in 2023, right? So essentially priced that we're going to have a 9-month tightening cycle, and then we're going to start cutting, right? So obviously the hikes are priced bigger than is normal for a cycle, right? Because we're talking about 50 and 75 basis point steps. But nevertheless, we were pricing a hiking cycle that was going to be essentially a year, and then the cuts were going to start. That, I think, is what's very questionable. I think we're going to have a situation where the services prices are going to be sticky, and it's going to be very, very hard for the Fed to switch to cutting mode. It might be the case that we're not going to be talking about 75 basis points forever. Maybe we're going to go to a more slow pace of tightening. Maybe we're going to plateau at a high level of rates. But this notion that the Fed is going to flip from super hawkish to getting ready to cut within a year, that I think is too early. And I think we're going to push that out, and that's not priced yet.
Jens, awesome to get your view on things, as always. A bit of a reality check from you and Exante Data. Jens Nordvig there.